Okay, good morning, good afternoon, depending on where you are in the world. Welcome to the third briefing for the SCAN Decarbonisation Quarterly. So today we're going to discuss a topic that was covered in the last edition, which was released last month, and that's the decarbonisation economics of mine fleet electrification. I am Sophie Chung, Director of SCAN Associates, and I'll be chairing the discussion today. I oversee the product content of the SCAN Decarbonisation Quarterly and lead the analysis on the corporate decarbonisation targets. So mine fleet electrification is a much discussed topic for the industry, and it's an absolutely key component of the roadmap to net zero. So on that note, we're very pleased to have join us two guests from the industry, Mike Sinden, Managing Director of Costmine Intelligence, and Philip Bangerter, Regional Manager, Australasia of Whittle Consulting. Mike has over 20 years of experience in the natural resources sector, predominantly in the area of research and data collection, as well as product management. And at Costmine, he leads the research and data business, growing the company's database on equipment and labor cost data, estimation tools, and software. And their priority analysis serves engineers, financial professionals, and governments. Philip is a mineral processing engineer and sustainability specialist with over 40 years in the mining industry across multiple commodities. Based in Brisbane, but in a global role, Philip assists mining companies access the optimization services, software, and implementation support provided by Whittle Consulting, with special emphasis on study management, carbon modeling, and sustainability. So thanks, Mike and Philip, for joining me today. Before we jump into the specifics, I want to set the scene by asking you, in the past 5 years, what changes, if any, have you observed in the questions that your clients ask? Is there a stickiness to exploring options to decarbonize?
Yeah, I'm happy to take that first, Sophie. We've certainly seen much greater emphasis. It's pretty rare amongst our clientele that they wouldn't try to address some sort of carbon modelling at least, and try to understand how carbon footprint is affected by their decisions, particularly their financial decisions. So a big uptick, particularly the last 3 years, I would say, but certainly 5 years ago there was the beginnings of that discussion. And so yes, I would think more than 90% of our clientele would be wanting to understand a carbon question, at least, if not a thorough understanding of how their decisions have an effect on that.
Yeah, for our part, I would say it's an interesting question because we're trying to balance a few different things: decarbonization, energy transition, but the bottom line is for investors is cost, right? And can we make these projects feasible and attractive to investors? So we wake up every day and think about costs. So all of what Philip said, but also how do we layer in the cost sensibility and cost control into the whole equation to get a project built?
I would say that understanding a cost is one aspect of the planning process. And if you're faced with two different costs, let's say, it's not just about which one's lower and which one's higher, but also about what effect that might have in the mine planning situation. So there's definitely situations where you would take the higher cost, but first and foremost, you have to understand those costs to be able to make that decision if that's the preferred. Lowering cost is not the ultimate objective of the business. It's to get the greatest return, and sometimes you can trade those off. So I'm with Mike here. Understanding those costs, critical to the work that we do. Part of that might be a carbon cost, but more specifically, are we also approaching it from a non-financial point of view as well? And we're finding that our clients want to understand those things around, let's say, water and tailings and carbon more and more.
And particularly when it comes to mine fleet electrification, I think the underlying assumption is that electric fleet equipment come at a significant premium to conventional diesel consuming fleet. And a few years ago during LME Week, we presented some analysis where if you just switch out the cost of a diesel mine truck, for example, with electric fleet, then the additional cost, that simple substitution wouldn't really be, absorbed sufficiently by, for example, consuming less diesel and such. And so when we ran a very straightforward analysis, it was showing that not a lot of mines would essentially go for transition to electric fleet if that sort of high level substitution impact was all you looked at. But now just taking a step back and understanding the bigger picture. I mean, Mike, you and I have a history going back to mine cost analysis with McKinsey, and cost inflation was always a key topic of interest. So what are you observing in the market now around conventional cost structures, and how does the cost of electric mine equipment compare?
Yeah, that's a good question. I think the energy transition, as I mentioned, is one big feature here, but I think pandemic really shone a light on costs and brought that whole conversation back. We saw a lot of really big disconnects in cost structures of some of these assets, not unlike what we saw back in 2012, 2013, when everyone was rushing to build iron ore mines and copper mines. So I think the cost thing has really come back. And I think from our perspective, it's really a case of dissecting those costs and pinpointing where are the pain points in the cost structure. If I could just show a slide. This is one I like to show. It's not the most sophisticated slide, but it really starts to pinpoint where costs where the costs are. So this is a standard 10,000 ton per day throughput asset of a 4:1 strip ratio. The left is the capex breakdown for such an asset, and the right is the opex breakdown. And you can see here exactly where the costs are. So on the capex, it's buying rolling stock, so steel, and then on the right, it's quite a clean break between labor costs. And anything that I always refer to as hydrocarbon leveraged. So anything from fuel to any energy costs, even things like tires and lubricants, mill liners, things like that. So that's just to sort of level set where the capex is, or the opex as well, in some of these operations, and without even starting to get into the electrification conversation. So there's some just good level setting data here. If I directly address your question around the trade-offs between diesel and electric, this is some hot off the press, shiny new data that we've got here at Costmine from our primary research team. So you can see quite starkly the trade-off between a diesel piece of equipment or its battery electric counterpart, and it's not insignificant, the difference. So I'll put it back to you guys to discuss this a little bit more, but you're talking about, Philip mentioned trade-offs. Is the trade-off worth it for 60 to 100% more in cost for a piece of equipment? Maybe, but maybe not. And I think it brings probably more questions than answers in some respects. So yeah, just to directly answer your question, Sophie, this is some of the data that we collect here, and shows quite starkly the trade-off. And that was a great word, Philip. I think that's a great way to frame it, as trade-offs. And sometimes the more expensive piece is the right answer.
And just to confirm that this is just once, for example, like a whole truck to whole truck, it doesn't include, for example, the supporting infrastructure like pantographs and extra battery charging stations and such. Is that right?
That's right. That's exactly right, Sophie. So it's, again, more questions than answers. What does all that ancillary stuff cost, right? And is it efficient to operate that kind of operation? And the answer might be probably in some cases, but maybe not in some others. So yeah.
And it's interesting because you do have to seeing where that trade-off might be. I know that you and I have spoken in the past about labor costs and how that's going up as well. And then I always think when we go back to the more sort of what we've observed in the mine cost analysis world in the past 15 years that you and I were doing it. I mean, every time there's a hotspot, like everyone wants to to do AI or optimization, or everyone wants to bring in automated electric fleet or something like that, then you're creating essentially like a hotspot, aren't you, where you suddenly need more of a labor of a particular kind, and that can really hike up labor cost rates and such. So that's the other thing that I think about when we talk about essentially what we're doing is like new technology, bringing in new support structures and such. But maybe this is a good point to ask. I mean, Philip, we were talking a lot about potentially higher costs, and how do these factors impact the way that you conduct the study for your clients? Like, are there any ways to offset the cost premium and push forward with decarbonisation? Any specific examples?
There's a lot to unpack in all of that, and I think context is hugely important. So whether you're in a high labour or low labour environment, whether there's automation available or not, whether you have a risk appetite for certain things. So it's not just costs. There's presumed benefits, and does it meet your risk profiles that you're willing to take? Are you a project or are you an operation? Is another thing. So retrofitting infrastructure into an existing mine, the shape of the pit, whether you've got a static wall on your pit where you could put pantographs or whatever. All of these things are contextual questions, and so it's not easy to isolate one particular factor, I would say. Perhaps the biggest thing I would ask the audience to have a think about is if you're only looking at the first order discussion points. In other words, there's a trade-off. There's a capex and opex trade-off, or there's a wish to bring your carbon footprint down by investing in electrification. Then, what effect does that have in a systemic way? So you can't just, as a process engineer, I've often scratched my head about certain things that are effective in the process plant, and never given a thought in my earlier days in my career to what effect that might have back in the pit and the mine schedule. And this is a really good topic to discuss if you're thinking about electrification. The fact that you might electrify your fleet has consequences to the ore body itself, and this is where optimization comes in. It's not sufficient in our view. It's not sufficient to merely understand the trade-off between the capex and the opex, nor indeed the increased costs of fleet in the current situation. If you have a material change in costs, it has an effect on the ore body. In other words, the cut-offs will change, or the decision about whether to bring the truckload of rocks that you've got in your truck. Do you turn left or right? Do you turn right to the plant, or do you turn left to the waste? And what effect that might have, or do you indeed expand your pit? Do you have the ability to shorten or extend your life of mine because of the effect that these costs have? So perhaps right at the moment, I would answer a question with a question and say, if you have a driving wish to decarbonize and electrify your fleet to achieve that goal, and you are willing to pay some extra, that bad news story is not necessarily as bad as you think, because the ore body will shift or change around you, and the optimization process will allow you to navigate that bad news story in a most effective way and reduce the impact of the financial impact. I mean, whereas Mike's business will happily support you in understanding the costs, our business will help you understand how to navigate any bad news story. And I might add, if you're talking about a wider range of topics in our industry, the opposite is true. The benefits you get from certain things changing with costs are magnified by optimization, and it's not just the Whittle optimization that does this. Of course, there's other ways to optimize, and you can often find that the benefits are greater than they first appear from a first order perspective, and the opposite. The bad news stories are not as bad as you might think. So I would ask, do you understand your costs enough to undertake a reoptimization of your mine plan when you understand them? So if you want to pay and more capex or more opex, whichever way around it is, what are the consequences? And I would, as a final sentence to that is to say whether it's CapEx or whether it's OpEx is important in the optimization. So a higher CapEx, lower OpEx option is very, very often an improvement in the way that the ore body responds, because capital costs are not included in the optimization calculation. They're certainly in the financial calculation, but they don't participate in the optimization. So if you're going to lower the operating cost, which does participate in the optimization, in a material way, it's almost certain you're going to end up with a better result than you thought of in the first instance. So that's, if it perhaps I could illustrate that a little bit with our famous triangle, which if I share, and I'd love everybody to think this way. The first order is really around, how do you assemble those capital costs and operating costs, and calculating that net present value, net present cost. The second order is concerned with that ore body. As I said, the total effects of those cost changes must be considered in how the ore body changes. Does it make the ore body bigger? Does it lower cutoff grades? Does it make them higher? And so on and so on. The third order is those drivers around how does that change affect the carbon or the water or any of the sustainability criteria that you might be considering. And then you can complete the circle, if you like, or complete the triangle in a circle. If you have a third order objective, such as lowering your carbon footprint, then what effect does that have on the first order? Because it is going to have an effect. And then don't forget to take the extra step around to second order and understand how the overall effect is because of that.
Thanks, Philip. That's really interesting. There's a lot of different components to think about, obviously. What you said about higher CapEx and lower OpEx almost always works in favor, because the ore body responds positively to it. I mean, I guess a classic example would be switching to renewable electricity, for example. Like, obviously it depends how the agreement is structured, but something like that comes to mind. But help me understand that a little bit better, because I think that can almost sound counterintuitive.
It can.
Yeah.
The way to think about that, and the inclusion of renewables is a very good example, as it turns out. The concept here is that if you've already spent money on capital, then it's irrelevant to the decision as to which way to drive your truck at the top of the pit. It's already a sunk cost. It's already there. So you have to make use of that asset that you've purchased. That's why it doesn't contribute to the optimization. It's embedded, and your decisions are now, well, we've spent that money, so now we have to make the correct decision about which way to drive the truck when it gets to the top of the ramp. And the other decision you have to make is how deep do you dig, and in what order do you take your shapes, your pit shapes, and which part of the shape you take first, and so on and so on. So that's all included. So if you can imagine, if you've structured your energy costs by having just paying entirely for electricity over the fence, that's one setup. Another one is that you invest in the capital yourself, and that can have a substantial difference to the way that the optimizer will respond. And bringing renewables into the question is one of those things, because renewable energy is a high capex, very, very low opex solution, whereas in a remote mine site you might have diesel options, diesel generation, and that is a low capex but high opex, and there's a fascinating comparison between the two, and the way that you structure your power inputs is very important. So it has more than one angle to it. The structure of your costing matters, and it gets tied up with all sorts of ways to understand and to calculate the costs. So electrification is sort of the next step after whether you're considering having green energy. So there's green energy at remote sites where that question is very important. And we've done a number of studies on this point, where understanding your solar and wind resources comes into it. What sort of renewables penetration do you want? Do you just want to go with a standard more or less 20% that you can get from having a sunny place in the middle of the desert? You can really only reach about 20, with that maybe a little more these days, or you can add wind and maybe get to 30% penetration, and then you can talk about storage, adding batteries or some other infrastructure to have storage to get more and more penetration. You can't just have a lowest cost of energy supply sort of attitude to that, because the structure, the capex versus opex question comes into the optimization, and the optimization will have surprising effects. So I think I'm trying to get a message across is don't forget about that second order effect that your investment decisions have. I didn't mention grid connected and buying green energy again. That might seem a simpler way to go about. If you have grid connection and you can buy renewable energy off the grid, still has an effect. The format or the construct of your contracts for that energy supply matter in optimization. So you really have to think about these things to get the best out of your optimizer.
Yeah, I think availability and reliability in that example is a good one. Like, how much do you value reliability there? One thing earlier on, Philip, too, it occurred to me, I was thinking about safety as well. Stakeholder came up in one of the slides, and I thought that was interesting. Safety is another huge part of this discussion as well, when it comes to any of these topics, I think, and that's significant.
Safety, obviously, and it's very difficult to, and perhaps you shouldn't include safety in your economic analysis. There's sort of no-go areas around safety.
Yeah,
that's developed in our industry over the last 20 to 30 years. But those productivity questions, though, so sort of human well-being, the electric trucks are much more comfortable to drive, and you get less fatigue, and all of those sorts of things can be included in your analysis. And are they material enough to count in the optimization is a very good question. And the ultimate expression of that, of course, is to not have a human driving the truck and to have it automated and so on. That's the most comfortable thing. You can have remote driving as well, and that's comfortable too. Yeah, so there's all sorts of things that can be and perhaps should be included in that. And I would encourage anybody that's doing optimization to think about those sorts of things. Are they material enough to make the ore body respond? We have a saying which is, what can this ore body actually do? Let's discover what this ore body can do, and then we can put in scenarios to understand what the effects are of making certain decisions and how does that affect. But that can't just be on a first order capex versus opex. You have to allow the ore body to respond in some way.
Yeah, and it all comes together at some point, I think, and we've seen, I think, examples of, for example, the big copper miners in Chile, for example, or actually in most of the big producers are doing this, is that they're setting up to electrify their fleet. So they're going on green electricity, getting the pantographs, getting the trolley assists, but they're also pushing the automation factor quite a bit. And obviously there are a number of reasons for that, but first, I kind of think that your reference to high capex, low opex is that obviously if you are on green energy, green electricity, and then you invest that additional, to set up the trolley lines and the pantographs, then I guess that's another example where you have higher capex, but then in theory, opex could be lower if you're not consuming as much diesel and your electricity costs are low. So that's another thought that I had. But also when it comes to, yes, you're still spending more, even if it's just from a capex perspective. So then, if you're trying to cut opex, then labor is one of the things. Just by going to automated fleet, that's another area that you can address, I guess. Mike, I know that you and I have spoken before about labor costs in particular and how that's escalated over the past few years. I don't know whether it's worth touching on that, because I know that you look into that quite a bit.
Yeah, I'll pick that up in a sec, but I just want to pick up on one of your points there. So if you mentioned large copper mines, I think the question is the lifeblood of the industry is not the large miners. It's the the huge volume of PEAs that come out every month and year amongst the citizenry of the industry, which are not large miners or mines. And the question is, do some of these trade-offs apply to these somewhat smaller mines and miners? And does it make sense? These are big capex numbers we're talking about, and with the inflation we've seen since pandemic, it's huge. And I just don't know, do these conversations even speak to that constituency in the industry? And we can have the whole big versus small debate, but I wonder, do these miners, the lifeblood of the industry, like I said, are they even thinking about this stuff? Maybe, but maybe not. It's just not, they don't have the luxury of thinking about decarbonization. Maybe, I don't know if at Skarn you guys tackle that question. Like who are you speaking to when we talk about decarb?
That's a great question. I think that, as always, I mean, I could, yeah, where do I even start? I mean, when you look at the targets that have been set by, it was kind of like, hilarious. It's literally like keeping up with the next door neighbor kind of situation, right? Where, around 2020 when I joined Skarn, that's when like a whole slew of targets were being set, and you could literally see like one person saying like 30%, 33%, this, that, with in line with SBTI, all by 2035. And then I think it's now that as those targets are coming up for review, so they typically get reviewed every 5 years, they're looking at the plans that they set and going, like I don't know about this. But I think the trend has been that obviously the big producers set targets, and so then that's made it has an effect, right? So even if you're smaller, even if your assets are smaller and they don't have as long a mine life, there's still this expectation that you should have a target of some description, and same with scope 3 at the beginning. People are like, no, we're not going to go do scope. Some people aren't even reporting, and then you've seen steadily that pressure kind of reflected in the sustainability reports that have come out in the last 2 years, where people, and you can see each year, it gets larger as they include more categories. But I know that's a really long-winded sort of response to what you said, but the pressure remains. So whether you're big or small or medium, I think that in some respect you have to address this question in one way or another. So I would say that in our conversations, and we have conversations with all the way from prospective developers, projects at various stages, all the way to operators of single asset, all the way to the big producers, and the pressure affects them all, really. But I think, going back to your point of how much can they really do, that's a challenge. We've spoken to just fund managers, actually, the private fund managers that go, well, your work is really interesting because these smaller companies, they frankly don't have the an army of internal analysts or like a big sustainability team to even start thinking about what they could do. And so I think that's where actually maybe the industry needs more help and perhaps more sort of value add from people like us, is that do they even have the time to understand like A, what the competitors are doing, B, like what options are even available to them. So I think there's a lot of work that needs to happen here. But I've talked quite a lot. I mean, Philip, I think you work with the smaller companies.
We do. Yeah, we absolutely do. Yeah. And Mike, the answer from our perspective is we very rarely work for tier 1 mining companies. There's exceptions, but it's a nice exception to have. Every now and then we'll work for a tier 1. They have their own optimization teams, and it's not a an everyday occurrence for us. We definitely work for mid caps, but we have a high proportion of our studies are done for juniors, where we're participating with the C-suite, understanding their objectives and so on. I would say that at least 75% of our junior clients are extraordinarily interested in this topic and understanding the trickle-down effect that the big players have enforced on the industry, which I think is wonderful, as we need to have this energy transition and decarbonize. So it plays on the C-suite's mind for sure, and they're often pleasantly surprised that optimization is actually quite helpful in these things too. We will report the carbon just as a matter of course. It's we don't even ask these days whether clients want it or not. They sort of get it by default, and then they're in possession of an extra dimension of decision making. So you're right, they don't have the team, they don't have the internal resources, and they're relying on, you know, a small army of external resources to get their PEAs done. And we think that decarbonisation is a topic of the day, and it is now routine. I would say the last 2 years it's been routine, and we always do scope 1 and 2 clearly, and scope 3 upstream is very much in our minds. Now, we don't do comprehensive scope 3 upstream to sort of wander into the territory that you mentioned, Sophie, but we try to get sort of the 80-20 rule around scope 3. So we are talking about the embodied carbon within your grinding media, within your explosives, within and there's a set of 6 or 7 that we would always use, and then maybe a club of 20 that we might use for scope 3 upstream. If we're talking about scope 3 downstream, which is Scan's expertise here, ours is normally limited to the transport outside from the gate to the customer's gate, if you like, and we do that, and we've published a couple of examples of that, which we might come back to later, Sophie, I think. But in answer to your positive question, Mike, I think the junior mining companies with a project are exercised by this in the main. I wouldn't say it's 100% at all, but it's pretty good.
Fair enough. Sophie, let me address your question about labor. So if I was not at all trying to avoid it. So we do detailed mine labor surveys in Canada and the US, and we've extrapolated that to international labor. So a lot of primary research. And if I refer back to that pie chart, from a North American perspective anyways, and it won't be too different in many other places, but that pie chart's about 40 to 50% labor in terms of your OPEX. So it's not nothing, that's for sure. Let me just show you this. So this is where we've come from, and we're not forecasting at this stage, but certainly where we're coming from wage inflation, it's been significant. So the status quo going back, say, 25 years has been about 2%, so roughly matching CPI, if you like. But certainly pandemic and even pre-pandemic, we've seen wage inflation well north of that, 2-3 times that, depending on the role for sure. And this would translate as well to salaried roles as well. So it's been significant wage increases. Unions have power, certainly in Australia and here in Canada, less so in the United States. So it's a bit of a mixed bag within these numbers. There's a few differences in different types of roles for sure, and that's where we like to show this chart. So within just the generic unskilled laborer, we've seen certainly less wage inflation, but as you start to move up to more skilled laborers, we're starting to see, you know, north of 5-6% in terms of annual wage inflation. So it's significant. The topic of automation came up. I don't know, you know, that could be a safety thing, but it could be a cost thing as well, and that's a whole conversation in itself. On the salary side of things, it's very similar. So, and in some cases even higher. So mine superintendents, as an example, very, very, very hot inflation that goes back to pandemic and even pre-pandemic in certain cases. So these are some of the things. Philip, I wonder if you could maybe come up with a couple of second order examples on wage costs and how, you know, you can try and decrease your wage costs, but what are the second order impacts perhaps of trying to reduce costs? Is it false economy to try and reduce labor costs? I don't know. I might pass that question to you. But certainly the devil is absolutely in the details on this labor question, and it has been significant, and it's becoming a bigger part of that pie that I showed earlier.
One thing we didn't mention, which was perhaps is related to this, is the performance of electric trucks. There's debate and different ideas around how fast trucks can go and up what slopes can they go, and those numbers are very important in optimization. Because it speaks to slope angles on your pits, and therefore it can have a lot of effect on your overburden. So that's a second order effect that is really important. And whether you can have a fixed wall on one edge of the pit, so you can put a pantograph on there and get those speeds and the charging as you go up the slope, as well as regenerating on the downward, all of those things need to be looked at. And unfortunately, you can't give a one-size-fits-all answer to these questions because of the context. And so we love getting into it because there's some unexpected turns in most of these studies that we do. And the only thing that you can say is that it matters. It usually matters. It's usually material, and it needs to be thought about in a mine planning sense as well as a procurement sense, if you like. You're not just swapping out costs. You're understanding the way that the ore body behaves because you've made that decision.
Like mine sizes are kind of shrinking. We're not off. There's not so many Las Bambas out there anymore, right? We're building smaller and smaller mines, and therefore you're having to get more and more creative about the types of equipment you're using. And but as the equipment sort of starts to get a little bit smaller, or specific or niche or esoteric, the costs go up. The per unit cost of a piece of equipment tends to go up as it becomes more specialized. And I think that is a really interesting topic, because can you apply electrification to a smaller esoteric piece of equipment? Can you find the operators for that type of equipment? Increasingly, the industry is finding new and wild ways to get to a unit of material, a unit of metal. Nickel comes to mind, right? We're having to get creative about how we get a unit of nickel, a unit of lithium, a unit of cobalt, and the equipment needed to build those operations is getting very niche, and the cost therefore goes up. Everything is becoming a little bit maybe more bespoke. So I've got a wonderful slide here that I'll show. So we're very good at collecting cost data for equipment, and we get all kinds of weird and wonderful pieces of equipment. But the chart on the left really shows what I would call a fungible piece of equipment, like your very classic 777 or a big haul truck. That's a fungible piece of equipment, that very standard. But conveyors, or in this case, I've got air separators, they can be quite bespoke or esoteric to a particular operation. And as that occurs, the miner has less bargaining power when it comes to getting that piece of equipment, and so the cost inflation goes way up. So you're still exposed to all the usual hydrocarbon, steel, labor inputs to building the piece of equipment, but you've got less bargaining power when it comes to the design, build, and installation of these more specific pieces of equipment. And do you even have the opportunity to electrify some of these pieces, even if you wanted to, because they are quite specific? I was just going to say, I think there's a lot of that second order effects theme in the bigger is better question mark. Is it necessarily better? It might be, but it might not be.
It's a question. If your ore body is actually naturally favoring small trucks, then you should go small trucks. And again, it's nuanced because of the context. Your labor costs, the extra cost that you must incur on the capex, or indeed your contracted rental charges, if you like, that they all play, and so it's not always obvious what you should be doing. You can't rely on bigger is better necessarily these days. So you have to do the work. You have to do the work.
Wow. Well, thanks, guys, for a great discussion. I think we could keep talking for another hour at least, but in this, for the sake of sanity and time, let's wrap it up. So we've spoken a lot about the various aspects of decarbonisation today, but if there was one thought that you want to leave the audience with in relation to the topic, what would that be?
Well, from my perspective, Sophie, I would say let's understand the costs really well. They're critical. So the sort of work that Mike does is hugely important and feeds our work so much. But I would leave the audience with a thought about the second order effects and the importance of it, and understanding that there are hidden gems in there, there are opportunities in there, and you don't do it justice if you consider only the first order effects of CapEx OpEx trade-offs and all those sorts of things. Let's see what the ore body can do with what you deal them with those new understandings around costs. That's what I'd leave it with.
For my part, it's much the same, to be honest. It's just these trade-offs. We can electrify, but what are maybe the hidden costs that we haven't thought of? Be it more road expenses, or like I said earlier, might be swapping out a truck driver, but we might be swapping in a software engineer, or we might be swapping out a high-skilled mechanic, but we still need some kind of fitter to do battery replacements. So I think there's a lot of hidden costs in there that we need to uncover, and I think the granularity that we do here at Costmine Intelligence is very illuminative to that. Just to shed some light on where these costs are, where the cost pressures are, and have we got our finger firmly on these inflationary levers that can often creep up on you.
That's great. Well, thank you both again for joining me tonight for my time zone. And Philip, have a great rest of the day. And Mike, enjoy your evening. And everyone, please stick around for questions. If you've got a question, just a reminder, put it in the comment box, and we'll see you soon in the live chat. Thanks. Well, thanks, Mike and Philip, once again for that discussion. We've got a few questions starting to come in. So just as a reminder, please send in your questions through the chat function in the webinar. So what some of the questions, let's have a look. Mike, I think this one's for you. Where do these costs come from, and have you got an outlook for some of these costs?
Yeah, good question. So just a quick word on the methodology. We do things the old-fashioned way, so to speak, here at Costmine. We are doing primary research. We go to exhibitions and trade shows, and we're collecting real-world equipment costs. We talk to the OEMs, we talk to service providers to the OEMs. So we've got a good handle on the CapEx of these pieces and the OpEx, largely from a North American perspective, but we can talk about that separately. I think we're going to talk a little bit about tariffs inevitably. But yeah, we do things the old-fashioned way, bottom-up primary research, collecting good old-fashioned CapEx and OpEx costs. When it comes to outlooks, we do not forecast them just yet, but I can give some sneak peeks into some of our recent data. On the labor side, some of the bad news is that we just put out our latest US labor survey, and we've put out the study. We're not seeing as high of inflation, but we're certainly not back to the benign 2% levels that we were seeing over the past 25 years or pre-COVID. So we are still seeing pretty hot inflation when it comes to labor and salaries. And we reasonably expect that to continue. Now, on the more tangible things as labor, I mean, I've said before, but it really depends on your view on hydrocarbons, certainly from a CapEx and OpEx perspective. So your view on oil in these bumpy times is fundamental. If you look at the pie chart that I showed during the presentation, 50% of the costs are levered to hydrocarbon prices, so be it petrochemicals or other. So that kind of very much drives what's going to impact your OpEx. So 40 to 50% labor. So your views on that, which we've got a good handle on, and then your view on Brent, say, for lack of a simpler benchmark.
So you might regret mentioning the T word, but since you've thrown it out into the discussion, I mean, you do sit pretty close to the United States of America. So with recent political activities and the topic of tariffs, given you work quite closely with US suppliers, I think, but have you had clients exploring how this is going to impact their business, and if you've got any insights you can share.
Certainly try. So I'm here in Canada, so we're riding the bucking bronco, so to speak. So yeah, clients are asking this question a lot. So with our data, albeit North American costs, we are getting the question quite a lot about, say, specialized German equipment, or if the US is importing equipment from, like I said, Europe, or here in Canada, we've got some mine-specific suppliers, especially electric vehicle makers here in Canada. We're a mining country, so we do export mining equipment for sure, and that is absolutely coming up. So it's only going to be inflationary, unfortunately, is the news. If you're a US miner building a mine and you're going to have certain pieces that are coming from abroad, you're going to get hit by these retaliatory tariffs. So that's just the bad news, and I think it's just going to drive a lot more of the onshoring and do it yourself. Is the problem. Now, the good news is, using our data, you can, with the different tools that we have, you can flex these. So you can bake in a 44% or a 134% tariff if you like, using our tools and models. So you can capture these costs. And then one final comment, though, probably on the positive side, is that we have an international audience that have always used our largely North American cost data. And there aren't a ton of arbitrage opportunities unless you're building it yourself in China or Russia. There's not a lot of arbitrage when it comes to the fundamental cost to build these pieces. It actually does come, and always has come, down to tariffs, import duties, and the like. And so you can, from a PEA, PFS level of accuracy, you can bake in a simple 20% import duty or tax. And we've always said that. We've always been able to use our data to using some of those assumptions. So while the news is not positive, estimating them from a cost estimator perspective is not that hard if you've got a good starting point on the fundamental cost of the data using our stuff.
Thanks, Mike.
Yeah.
And I mean, we just touched on the US, but what about some of the other countries, I guess? Do you, yeah, maybe you can, provide some insight on that.
On other countries, sorry?
Yeah, so if I think you said that you've got a lot of US costs in your database, but I guess
Yes.
how do they differ? Like, are there some sort of nuances worth mentioning comparing US costs to some of the other countries?
Yeah, so like I said, I think what we find and feedback from users of our equipment cost data internationally is that it's good. It's really good. And you factor in some of these import duties or tariffs, and that data is quite stable globally. Like I said, China and Russia can be a little bit different especially if they've got large domestic manufacturing bases. So that part is relatively transferable. The labor side is different, but I think our view and the feedback we get from our clients is it nets out. So for example, in our models, we factor in operator efficiency or labor efficiency. So while labor costs may be lower, or some jurisdictions you might have more labor, or unions dictate certain parameters around the size of the workforce, a lot of these things in our feedback tend to get netted out. So lower costs, but maybe higher numbers of laborers at a lower efficiency. So there's a number of factors in there. One other dynamic in our data would be, I think I mentioned in our presentation, was the unionization effect. So Australian labor costs are higher, but they're more predictable. And once these CBAs are locked in, we find that the trajectory, and if you look at the historical path of Australian labor, it's a lot more stable because of those unions. So it might be higher, but it's more stable. Whereas in the US, it's a lot choppier, the labor data. And so perhaps overall lower, but not necessarily predictable. And then you can even, with our data, you can dive into commodities. So coal mining versus base metal mining, underground versus surface. So if you start diving in, the nuance starts to get even blurrier, but at a high level, labor more so than equipment, you need to take a closer look, I think, at costs and be a bit more critical.
Thanks, Mike. Got another question come in. How does carbon pricing impact the decision making, considering asset life is 10 plus years for most equipment? One of the things that Philip said, I think, when I was speaking to him about the total report, writing up the report, was he said that ultimately you can have carbon pricing as an input line in the first order effect, as he calls it. So, this is the carbon tax number for this year, 2030, 2040. But the general sort of thinking from the modeling this is that given the obvious sort of ranges that people talk about, so between $50 and $200 per ton, is that it's not really a driver of scenarios. And so yes, it can come in as costs, and then you can also figure out how much you might be able to save by not consuming diesel. But at the first order level, the understanding is that it's not the big lever, it's not what the thing that swings the scenarios. However, as Philip mentioned in the presentation, is that almost every client that he works with, they want to at least consider a scenario where electric fleet come in.
He made some good points in the discussion around CapEx versus OpEx, and I had a chart that showed 50 to 100% premium on a CapEx perspective of a BEV versus its diesel counterpart. So I thought that was a very well made point around that trade-off. And if you're optimizing on OpEx, well, just have a quick look at the CapEx trade-off though too.
Yeah, and this is the graph that you're talking about, isn't it, Mike? Where this is just for reference, this is the full report, in case you're wondering what this is, and that's the graph that I think Mikey spoke to this, didn't you, about the premium there.
Yep.
And so fascinating. This is where it all starts to join up together. So Philip, one of the questions is, so how do you see mine fleet electrification playing out for bulk commodities where pit configuration or resource modeling perhaps have less flexibility to be optimized?
That's a good question, and I guess I would say optimization will occur in both the base metals type operations as well as bulk commodities. We do quite a lot of work in iron ore, and there's optimization available. But I think the question is about electrification in those circumstances. The beauty of let's use iron ore as the example. The pit shapes are much flatter and shallower in aspect ratio, and maybe directional mining is at play as well, or multiple pits. All of these things are very contextual. I would say electrification has got a different place in those bulk commodities, because you've got longer distances, flatter, less slopes, and more opportunities for other types of electrification, such as conveying rather than trucking. So I think it's contextual. We don't see any different focus from our iron ore plants than we do with our copper and base metals plants. So I say it's just different rather than there or not there. So we don't see too much difference. So as I say, we do studies in iron ore just as much as we do in the base metals.
And just add on to that, I think in the full report we go into some of that, don't we, Philip? But where you provide some nuances, for example, specifically around the conveyor belts and how that's got a sort of a critical angle threshold. And so from that perspective, the bulk mines have access to certain technologies that wouldn't necessarily work for the base metals for pits like that. So I guess it's not a binary, this works, that works. It's in the details, as you say. I've got another question. Have your studies that incorporate electrification shown that second order effects are important in all cases?
I would say you can't say it's all cases. I would say that there have been studies where electrification is not shown one way or the other, whether it should. So it hasn't paid, and then you're into a it still hasn't made the mine or the project underwater. It's still profitable, but there's a big chunk of return disappeared. Then it's a risk appetite. Are you confident that you're about any particular premiums for low carbon or whatever it is? I mean, you're able to green your electricity from the grid often, and many mine sites have done that. So you're sort of 50% of the job done with that, perhaps slightly more. It really is about whether you're driving to those targets that you mentioned when we had the recording done, Sophie, about targets. If you want to make those targets, the easy win was the greening of the grid electricity. And now that the electrification is the next biggest thing, there has to be a decision. I just reiterate the fact that it's a bad news story in many cases. Second order effects most often help, not always, I think is the answer to that.
Okay, yeah, thank you. And we didn't talk specifically about some of the case studies that we discussed in the full report, but would you mind elaborating on those and perhaps share some specific insights? I think it helps people understand the concept in a way if we use real life examples.
Yeah, I think you're referring to the published case studies that we've had the privilege of being able to publish, and thanks again to Dundee Precious Metals and indeed Nordic Iron Ore for allowing us to do that over several iterations, I would say. In the case of Nordic, they're Swedish, and which means that their grid is nice and green, and most people know that Sweden is a sort of an epicenter of thinking about all sorts of things green, including green steel and so on. So they were very, they had done a PEA, and we had helped them with some optimization, and then it became quite obvious that they wanted to look at electrification. So we did that, and what it really told us is that if you're thinking about scope 1 and 2 only, you can get an enormous benefit in reduction. And this particular exercise really didn't have a huge negative effect on the NPV. It still had a good result, and you could evict 85% or 90% of the carbon out of that just by electrification. It's quite neat, at least at scopes 1 and 2. And you could get rid of 50% if you included your upstream scope 3 as well, and that transport scope 3. Believe it or not, that was sort of shunting of the concentrate in a rail yard that stopped them. So that particular part, Swedish rail system is mostly electric, but there's parts that aren't, and that happened to be the thing that really stopped them getting their scope 3 down as well. So they were very happy for us to add that layer of study on electrification. And sure, it helped reassign the costs, and this was sort of a combination of open pit and underground, and a combination of hematite and magnetite. It was a very interesting study. In Dundee's case, there was this one was definitely about a scope 3 downstream story. So they had a couple of options on where to send their copper gold or gold copper, depending on where you were sending it, concentrates, and heavily influenced, as I'm sure everybody knows, their Bulgarian operation. It's high in arsenic, so there was more or less, there was quite a decision to be made around the final destination of that concentrate. So when we went about it, it turns out that the CO2 footprint, when you consider long sea journeys, and once you get to a country of destination and then put it on either a truck or a train, and the distances are different for different things, they were able to understand that the customers, the particular customer that they could choose from, mattered from a carbon point of view, and that was very interesting. Turns out with a relatively short mine life, the amount of optimization within the underground mine, the things they could do there weren't all that material. But interestingly enough, the carbon story was definitely material. So that's just another example of how interesting this can become. And at the time, Dundee were very preoccupied with their carbon footprint. So it was a good way and helped them make some decisions about the ultimate destination of the concentrates.
Thank you, Philip. I think that we'll wrap up there. Thank you, everybody, again for joining us. And we do cover more on this topic in our decarbonisation quarterly. So please do get in touch for more information, either on the full report for this topic or the product in general. We will send you a link to the recording, including the Q&A, by email next week. And in the meantime, please do send on any additional questions you think of, and we can direct them appropriately to Mike and Philip for follow-up. So thank you once again. Have a great rest of your day, and we'll see you hopefully for the next one. Thank you.